All right, so all right. Hello, everyone. This is Aaron Yoon from iFlip Invest. We are having a little bit of a technical difficulty with getting our very own Kelly Korshak to join this call. So for everyone that's been very patiently waiting, I appreciate your patience as we get this figured out. Oh, wait. There he is.
Hey, Aaron.
Hey, Kelly, you joined us and you're live.
Yeah.
I was just apologizing to our audience here that we're a couple of minutes behind, literally just a couple of minutes behind because of some technical difficulties. Thanks for joining us. You were able to make it.
So my link is all of a sudden my synchronizing of the emails to get the link is trying to synchronize my entire file now of all times. But
yeah,
so
it's
really,
like
seriously, does it have to do it now?
Yeah, seriously, like it's like when I want to get a stream going and Windows decides to update right there and then, right?
Exactly.
Lovely.
Now?
Yeah, like seriously now. All right, so if you haven't already noticed, everybody, I did not send out a Zoom registration link for tonight's AI Circle show. Rather, we send out email notifications. Hopefully, you're already subscribed to the channel, to the YouTube channel, and you already have the notification bell on so that you get notified whether you're on your mobile, whether you're on desktop. We should get notifications all over the place from iFlip now. I think we have a pretty good lineup here. So Kelly, for you, this is going to be a slightly different because they're not going to be on Zoom. The Zoom chat will literally be empty today for the first time. And this is how it's going to be going forward. We're going to be strictly on YouTube. And the fair warning, even your comments get saved on the YouTube channel. So if you had some spicy things to say that you don't want posted on the YouTube channel, maybe be mindful of what you say. So I'm going to kick off my screen share now, and let's get going.
Can I share my screen?
Okay, we can share your screen.
It's always I like to have a little show presentation with this because there's a lot to talk about tonight, everybody. The markets, sure. I think everybody knows of what's going on. Okay, let me try there. I can share the screen. There we go. Share. Wide. Because I like to use these charts as part of our talk points to everybody. Can everybody see my screen?
Yeah, they should be able to see your screen.
All right. All right, everybody. Welcome to the AI Circle again, Wednesday on 9/28 of September. Well, 9 is September, right? Of 2022.
Yeah, it's September already.
Tonight or late this afternoon, depending on where we are on the coast of this country or other countries, there is a lot to talk about. And as we can see, that we all know that despite today, the markets are in a very clear downward path. In front of you, you see a chart. Kind of looks like the stock market, doesn't it, everybody? But these are the 30-year Treasury bonds traded at the Chicago Board of Trade. And we are in a secular bear market, which means interest rates are going up as the prices are going down. Back around COVID, as we see 2020, the interest rates went to all-time kind of lows and they spiked lower. Generally, when you see movement like this is the beginning or maybe the capitulation of a trade. This market, everybody, is what I grew up in the 1980s. This market was priced for a US Treasury bond future was priced at $56. Today, at the peak of when COVID came out, it was $187. Actually, it traded over $190 at that time, which means interest rates went from a price of 56 to 192. And I won't get into the coupon changes along the way, but basically, we have entered a secular bear market on a 40-year bull market that has ended in the bond market at the beginning of COVID. COVID marked literally the low in interest rates. And by the way, why shouldn't it? Given the amount of money that the worldwide governments pumped into the system along the way, but basically, so if we look at this, we have seen interest rates go from a low, this price represented about a 2% interest rate on a 30-year bond. And today we are now looking at approximately a 4% interest rate on a 30-year bond. So interest rates on US Treasuries have doubled. And we can kind of see that in the mortgage market as mortgages went from just under 3 to now over 6. This is the reason why, everybody, a main reason why the stock market is going down. But let me show you the other reason that people are losing sight of, and this is the more important one. This is a picture of the US dollar. The US dollar is in a huge secular bull market. It's a great time, everybody, to travel overseas. Our dollar is buying more hotel time, more Uber time, more food, more everything overseas. Our dollar is the strongest it's been in history. And no matter what currency we look at, this is the case. Let's look at the euro. In 1998, the euro was formed. It was priced higher then than it is now. The euro is making all-time new lows. That's why the dollar is making all-time new highs. The euro now is at 97 cents. It's basically, for most of my life and most of your lifetimes over the last 24 years, the euro generally priced itself around 130 with a high of around 146. Now we're at the prices that we have never seen, even when this literally began as a new currency. Let's look at the British pound. See this over here, everybody? The only time I ever saw the British, this is, by the way, all-time lows for the British pound. It literally traded at about 103. It bounced to 108. But this is a time when obviously the British pound is under deep threat. It's under threat for a lot of reasons. But the biggest reason is the Bank of England so far is, even though they've raised rates once, they are now buying bonds again because they're frightened of the value of their own, of their currency in outside markets. So aside from a new prime minister, this is a currency that we need to stay away from for a while. But I suspect that we may either be close to the lows in this currency, but it's very possible that this could go to parity with the dollar and with the euro. That means right now, the dollar is the safe haven. And it is because we are the only country that is aggressively moving rates up to combat inflation. I will make one comment here. It's political, but it's not meant to be. At the end of the day, all the countries I'm mentioning, whether it's Great Britain or the European Economic Community, the EEC, but I can even go into the Japanese yen, which we've talked about before. This is the result of socialism, folks. It is clearly showing that countries that put so much debt out there to help finance its populations, the value of their currencies becomes meaningless. And then possibly is leading them to a situation where they are going to have to devalue their currency. So we have a worldwide economic problem, and we are in the middle of it, not the end of it. We may sadly be only in the beginning stages of it. There is no wonder why the US stock market is selling off. The reason, so let's look at finally the thing that we care about and why this matters to Flip and to the way we run our AI and our product on our platform. As you can see, the stock market peaked literally at the end of 2021. Ever since 2021, the stock market, through various legs, has made new lows. It recently has bounced off kind of its old low, but why has that happened? Today was the bounce. If we zoom in, look at this bounce. It looks very impressive to everybody, doesn't it? Why? Here's why. Very obvious. The US dollar came off of all-time highs, but it made a new high nonetheless. This is a dead cat bounce in the stock market. The reason it was bought, the stock market was bought today, is because the other things bounced and they took off their highs. These markets are in huge bull moves where the dollar is becoming stronger and stronger. Interest rates are going lower and lower, but that doesn't mean they go up in a straight line or down in a straight line. They move around just like the stock market. Stock market had its cues today from seeing a retracement in the dollar and a retracement in interest rates. But I can tell you one thing, everybody, all of my experience tells me that our AI is correct. Why? Interest rates just don't go down for a little bit. They go down for years. Years. They went up in price and down in rates for 40 years. I only see 2 years of movement in this bond. I fully suspect this, as I predicted earlier in the year, this product will go to 100. It's at 127. That right now, I predicted that around 160 area, and now it has lost 30 points. So these markets are still going lower, which means the US stock market is also going to go lower. Any bounce is to be sold. Going back to the stock market one more time, then we'll switch over to the other things about AI, because there's really so much to talk about. When we go back to the stock market, let's take a look at the S&P futures. We are going to understand that this market probably will ultimately price itself literally to the COVID lows. Where are those? They are here. I suspect we can easily move to 2,400 on the S&P 500 futures. And guess what, folks? We're not even halfway there. That would represent approximately a 50% correction in the S&P 500 and in as much as a 65% correction in the NASDAQ. And it's just a matter of time. I suspect that the bear market will continue generally up until the end of the first quarter minimum of next year, which means we're coming into the third quarter. We have another 6 months of let's not touch this market. As we all know, most of our systems have been in cash since early in the year. We are down around approximately 4% on our main model. And as we all know, the S&P 500 is down around 21%. So we've had a very good outperformance of the market by just sitting on the sidelines and waiting. and we should remain to do so. I will tell you, in my 40 years of the business, I started when the interest rates were at their highest level and the stock market was at its lowest level after the 70s, where it went nowhere. It is not hard for me, and hopefully most of the people on this webinar, to recognize that this is definitely a seminal point in history, and we should all understand that. And the reason we need to is because somewhere within the next 6 to 9, 12 months, we will be entering a phase for a massive opportunity to buy stocks. Massive. But we can't buy them now because right now they're only on sale for 20%. And frankly, I think there's another 20 to 30% lower. And so what does the AI say? The AI obviously predicted this. We saw a couple of wiggles in the AI, I did at least, at this little buy area here. It looked like, and there was a little spike up. But algorithmically, we couldn't take the trade either. So remember, folks, we have an algorithm that executes a signal from AI and also an AI signal that will override an algorithm. So in this case, we had algorithms to buy the market up here, but we were overridden by AI, and we had a situation here where AI actually thought it was okay, but algorithmically we couldn't buy it. These things work together to form our buy and sell signals for your portfolios.
Kelly, I want to jump in here. I think what you said was brilliant in terms of illustrating the difference of, and the difference between AI and algorithms and how they can work together, how you need both. And this gets mixed up a lot. We're one of the only companies that I know of that actually talk about and utilize and take advantage of both properly. Can you just elaborate on that just a little bit?
Sure.
A little bit deeper on that.
Well, think of it like this, everybody. Algorithmically, we look at price data and derivatives of price data. But AI-wise, we look at fundamental data in a far deeper way. We do look at some price data under AI, but mostly we look at fundamental data. Fundamental data is things like earnings or cash flow or credit card debt, or if I was trading soybeans, folks, we would be looking at the weather. So at the end of the day, AI looks at fundamental information in large part, and algorithmically, we look at price information. The two of them together yield a more powerful result than using any one of them individually. At the end of the day, the AI signal is the stronger signal than the algorithmic one. Why? Because it's able to sense things that data, plain price data, can't do. Plain price data is just a reflection of the way the market interprets the value of a stock or an index at any given moment. But fundamental information like earnings or credit card debt is things that price information, for example, from an index or a given stock doesn't see. Stocks don't see generally, unless there's a person that looks at it, the information coming out of credit card debt. It is not something that can be evaluated the same way by an algorithm as it can be by AI. AI, remember, is reading data in a completely different way, and it builds a model. Whereas an algorithm is a model that is built by a person. So I can build an algorithm, but AI can also build an algorithm. I would trust the AI more than myself. But I do believe that I can contribute to building a good basic algorithm that contributes to what an AI algorithm builds for me. we combine them together. And that is kind of the secret of how Flip works. That's how we are able to step aside from the market, especially when markets move down. The news is, folks, that the markets move up 85% of the time. I think I've said that many times before. They only move down 15% of the time. Well, right now, everybody, we're in one of the 15% of the times. And this is where it really counts. And this is why Wall Street, in my opinion, and all those analysts that you might see on CNBC or Fox or Bloomberg, why they always say the market can't be timed. And frankly, and again, this is my opinion, they are just simply talking heads that represent their own book of business, and they keep all of their clients in 100% of the time. Very few of those analysts will ever get their clients out. Why? Because they're afraid that their clients, if their money isn't invested, that they will leave them. They're more afraid of their clients leaving them with cash than making them lose money where they're actually afraid to take their money out. So why not just tell them to stay in and ride it out? It always worked before.
Yeah,
Well,
there's something to be said about the psychology of when you've lost. I don't know the exact, I'm not a psychologist, but I know there's a technical term for this where it's like in poker where you're pot committed, right? You're like, oh, I put in so much already. I've
don't wanna
lost
give
so
up
much
on it.
already. I'm essentially paralyzed and I'm essentially rationalizing doing nothing, and which is synonymous with just hoping and praying that things go back.
It's what we call
I'm gonna
it's
pull one
becomes
out here. Sorry, I'm gonna call you out on this, but we have a question in the audience, like when will the market go back to normal? And I will be the first one to say, this is part of the normal market cycle, right? Recessions are a part of the normal economic cycle. You can't only have a bull market. Okay, so that's not so this is part of the normal. It's just the more, let's say, less popular side of the coin, side of the cycle. And yeah, so this is something, when you say back to normal, probably you mean back to a bull market. And nobody really has a crystal ball. We can't really answer that. But the psychology of it is, right now, a lot of people are paralyzed. Like, ooh, I just have to wait. Especially the people who are the buy and hold for dear life crypto enthusiasts. They're like, oh man, whether it takes another 6 months or another 6 years, I can't touch that crypto now because I have to make my gains back.
I think, Aaron, you're right. I think you're right about, in the poker analogy, that you're pot committed, which means you're committed to staying in when all of a sudden you might have what you think is a full house, but somebody is betting strong against you. And it makes you think your full house isn't enough because they might have 4 of a kind. So we are in a situation similar to that. I would, however, answer that question a little different. What is normal? Look, if 85% of the time the market goes up, we probably could say that that's normal. So I think the question you're right, could also be interpreted as, when will it start to go back up? And here's what I'll say to that. It isn't right now. Why? And then this will get to timing. It isn't right now because right now the Federal Reserve has made it plain that they're going to continue to raise rates until they can see an effect on inflation. However, they're not going to be able to put inflation back at 2% anytime soon. Inflation will run hot. As much work as they do, it may go down to 4 or 5% from 8.3 where it is now, but it takes time to do that. Furthermore, in the fourth quarter of the year, we already know there's going to be some energy problems in Europe, and that means we could see energy spiking again, and that is also deeply inflationary. So we have a couple of reasons to say that it will not happen anytime soon. I can also add to that when interest rate markets start to go up, they go up for years, not months, years. And we are only 2 years into higher interest rate environment from COVID. I suspect that that could last 2 or 3 more years minimum. And if that's the case, and it takes that much time to be able to see an effect on the market where the Fed feels they can start pausing interest rate hikes, that is when we want to buy the market. When they pause, that means they feel that interest rates no longer have to be raised to battle inflation and the damage that they've done, which will be a recession, maybe several recessions. Remember, back in the 80s, if you guys know anything about it, I remember 3 separate recessions, all caused by Paul Volcker, and everybody in the country hated him because why? He stifled business. And I remember they were complaining about Paul Volcker at that time, even though historically he's recognized as the best Fed chair we had. And of course, he was superseded by Greenspan, who was probably the second best Fed chair we had. And so when we see that, and I suspect we can see something, maybe by April of next year, March, April of next year, we will see the Fed starting to signal or slow down interest rate hikes. But don't be surprised to see short-term interest rates go all the way as high as 8, 9, 10%. Right now, folks, we're only at 4.2. That also inverts the yield curve, which is also historically a bad sign. It creates recession. So we will see job layoffs. We will see some price reductions in real estate. We will see further price declines in some larger stocks like Apple. So for example, Apple has held up well, but interestingly, today it didn't. On a day when the market moved up 600 points, look at Apple. Came off its lows, but it doesn't matter. Why? The iPhone 14 announcement isn't enough. They rallied it for the 14 announcement here, and now they pulled it off. Apple has held up well. I suspect Apple will be a $100 stock over the next 6 months. Obviously, putting wokeness aside, I think it would be a great bargain at a much cheaper price, but it is no bargain here. So we have a lot of things going on. All the dynamics are bad for the market. Look at this. Look at oil real quick. Oil fell out of bed. ExxonMobil did anyway. But look for this price to go right back up towards closer to 90 to 100 relatively soon. But that doesn't mean the market will go up, because that's also inflationary. We have so many problems out there, folks. I have not really seen it. I'm so glad that if you're on our platform, that we want to be in the market, we will be, but the market is going lower, and that gives people on our platform a huge advantage to not be fearful when the time comes to buy, because you will be buying at a discounted price when everybody else will be holding on to their stocks for fear of selling them, thinking that if they don't take their loss, then they really haven't lost, which is a crazy psychology, but that is the psychology of the market.
Yeah.
And part of the reason we have our platform, I think everybody knows, is so that we don't have to panic in times like this. We have to look like predators for the opportunity to buy things that become cheap, so we can ride out a movement up like we were able to do in the oil stocks after COVID when they had their huge move down. Remember? So this is the reason we're all here, I hope.
Got it. Okay. So I did put up a poll into the YouTube chat, and I asked, have you taken advantage of our AI smartfolios and stayed out of the market this year? Which clearly evidence says, even if you did that manually, you forgot to trade or invest this year, you just sold everything, you'd be ahead of the market. And 77% of you said yes. And that's a really great number, Kelly. 77% of this poll anyway has saved money by using our smartfolios and staying out of the market. Maybe a little bit, boring, right? We all want to be making money, but in a year like 2022, not losing is the same as gaining, as we watch the markets just slip further and further to the downside.
Yeah, Aaron, I think that's great information too at some point, but I can tell you the one thing I want everybody to understand, this is not the time to look for bargains or what you think is a bargain. This is something different, folks. This isn't a dip. This is likely a change of a secular trend. There's a difference. Remember, sadly, I have the luxury of being in the markets for 40 years. I've seen this before. It's a movie. How many times have we all seen Casablanca? Maybe more than once. Maybe some of you have never seen it before, but most of you hopefully have, and you've seen it again and again. You know the lines. This is the way I look at the markets today. One of the things most people have to wrap their arms around is there are times to be invested and there are times to step aside. And just because you're not in the market and your retirement money isn't working, it is also not losing. And that's the bigger deal. One of the things that was mainly taught to me is to live to fight another day. Cut your losses short. Frankly, the only opportunities I see before the next 6 months, and I am on the hunt for them to create something we can buy, and that would be something in a change of the trend of the US dollar. Since we are a platform that trades US equities and not even bonds, we want to be involved in things that trade equities, that throw off dividends, because that's where our retirement money belongs in general, in the long-term growth of the country through its corporate structures. Now, that doesn't mean that's always the best way to do it, but generally it is for most people. However, as you know from a previous AI circle, I'm very much keened in on looking at things revolving around the US dollar. And in particularly, here's the Japanese yen. The yen offers an interesting opportunity coming up, I feel, for some kind of a reversal because of different policies that are going on in that country. I am looking for the trade. If I find it and it's a way that we can execute it on the platform, you can count on the fact that I will deliver it. We'll have an AI circle or a special presentation where I will opinion an idea to everybody, and maybe they would want to use it and treat it like information and news and execute on it. And also I can create a portfolio that we would be able to click on and use, which is the better move, to be able to participate in a long-term return to normal, but do it not through the equity markets, but try to do it through the currency markets. The currency markets are more likely to switch around before equity or debt markets. So, and they could be even larger opportunities. I will posit that to the people in our platform, and I am looking for it myself. I want the trade. I know it exists. I know it's right, but this is one that also has to go through at least some form of algorithmic approach or some kind of analysis that can say where we can manage risk and reward in some way that allows me to put it on the platform for people to choose to put it on into their portfolios or not. The great news is we're holding money aside in general. 77% of the people are doing that. But the other great news is there will be opportunities that are beyond amazing that will come in the months to come. But one of them will be a different kind of an opportunity if I can find it inside the US, something executable on our platform that is around currency markets. Because those things need to have a balance regardless of worldwide problems and worldwide issues of socialism existing in other countries. Well, that can be used to our advantage. So I want to use that. Oh, by the way, before I take some questions, let's look at Bitcoin. you might have noticed that even though we had a recent move down in the stocks, the Bitcoin really didn't get too badly hurt from it. It did not make new lows. We may be in a beginning of a decoupling of the stock market and Bitcoin. Notice we're sitting right below 20,000. We got as high as around 25,000. So yes, these are moves, but these are relatively small for Bitcoin when I consider the stock market just lost 13% over the last 2 months, and Bitcoin just lost a little more than that. So normally when the stock market would lose 13%, Bitcoin could lose 50%. Now it's changing, which means that something is afoot, as Sherlock Holmes would say, or Conan Doyle, in the cryptocurrency markets. So I'm looking at that as well, but I feel the bigger opportunities in the shorter run are probably currency related. The next ones are probably inversing on the bonds, and the final ones would be the stock market themselves, where I feel we're just in September. It's proving to be the month always that it is generally bad, and therefore October is just almost as bad as September. So again, it's very clear that we shouldn't be doing anything through October. And maybe everybody, on a final note, is you can tell in my voice, you become more adamant the more obvious it becomes. And to me, it is extremely obvious that the jig's up on the bull market that we've had and the stock market since COVID, because all the toys have been taken away. An accommodating Fed is gone. They're not only raising interest rates, but they've stopped bond purchases. We still have no leadership out of the White House to get things better. They're still trying to spend money. I don't see a reason, including the midterm elections, even if they sweep to the other side, that they're going to immediately be able to affect changes. So much damage has been done to both the markets themselves and the psychology of people in the market that it's just not so easy to recover. So let's keep to the sidelines, probably create more market letters coming out. I'm sorry I've been devoid of some, but the markets are moving so much that it's almost hard to keep up with them because they're just, the moves have been massive. Aaron, if there's any questions, I'm happy to answer.
We will. So if you have any questions, now is the time to enter them into the YouTube chat. We already have a few and we'll get to them in just a moment. I just wanted to reiterate, maybe because the thing is, aside from like Apple and maybe Bitcoin, the vast majority of the charts that Kelly has put up today are either from the futures market or the Forex market. Now, that's not usually how we handle AI circles. A lot of times we pull up smart folios and stuff like that, you know, but this is just a really good example of how you have to be nimble and adapt with the market. You have financial environmental changes afoot, like Kelly said, and you have to know more than just the stock market if you want to be a true investor and a master of the financial markets. Hence the event name, Mastering the Markets, that we have coming up in just a few weeks now. So if you could choose to just wait until Kelly figures out a way for you to take advantage of that dollar yen trade, or you could be proactive. And I'm not saying everybody has to, but if you want to, you could be proactive. You could learn about Forex, because really all he's saying is short the dollar yen at what, like 140 something, right? And aim for maybe 130 something, right? That's it. That's all it is. It's a short trade, right? If you know the Forex market, you know exactly what I just said. If you don't know the Forex market, then you're like, what the hell did that guy just say? Now, if you want to understand a little bit more about that, our event in Dallas is probably the best place for you to get exposed to that kind of stuff. Futures, same thing, right? Futures are a little bit more complex, and because they have expirations you got to deal with as well, right? When do you ever deal with that in stocks, right? So there's a little bit more to it than that, but it's a great place for you to get your feet wet on those markets. So I'm not going to bring it up because we want to get to the questions, but get your tickets now for the Dallas event if you want to take advantage proactively about this stuff that Kelly just said on the AI Circle tonight. Okay, so now let's get to some questions. I'll go in pretty much the order in which they were submitted. Well, the first one is kind of a fun one. Kelly, how high will the VIX go, do you think?
Well, generally, let's take a look. I just think I scrolled through it. Well, I can tell you, I wouldn't be shocked to see it go here like we did in COVID.
So all the way back into the 80s?
Yeah, it could. 70s. It easily could. I mean, the markets, look at how the VIX responds. It's an index that wants to always go lower, very similar to a reverse ETF that has decay, because people, especially the people that are controlling markets today, are very young. They have never seen this before. Mm-hmm. And they're far more optimistic than they should be given the events that they've seen. Most of them have only seen a bull market. They've never seen a bear market.
Right.
And I could quote a movie, but I won't. I laugh at this because this is where experience matters. All of these things are things that only someone that is maybe my age or older and has been around the markets as long as I have seen. I feel you can tell on the TV that the pundits are still trying, these younger money managers are still trying to convince us to be long the market. And their only way of convincing us is this: the market always goes up. But they forget it only goes up 85% of the time. Mm-hmm. So I could yell at the screen when I hear that and say, what about the other 15%?
Right.
So they don't say it. The VIX, right now, we haven't hit a fear index. We've heard that the fear index was moved, that we've gone from fear to kind of extreme fear. Extreme fear is this. We're nowhere near this. This will occur at much lower prices when they realize that right now they've lost 20 to 30% on their money. But when they start to lose 30 to 40, and they meaning the population of America that is invested, then they will have true fear and closer to panic. Then we will see something that we would maybe want to buy. I don't suspect we see this until the market starts to move down over 30%. So right now we're not down enough to be able to get the VIX high enough where we can feel comfortable to buy it. So therefore, look for a VIX above 60 before this is ever over.
Well, so let's see who asked that question. JJ, you heard the number. Now, obviously, I forgot to read the disclosures today because of the technical issues, but we're not recommending or advising anything. This is just an opinion. Let's be very clear about that. Okay, let's move on to the next question. If war is to ramp up in 2023, would it be wise to buy defense stocks? Will they go up as the market goes down into next year, or will they go down with the market? And should we pick those up later too?
I think that's actually a good question, but here's my spin on that. Defensive stocks are good in a regular market when you feel that a defensive stock like let's look at like a United Technologies or a Raytheon. War meaning, I'm assuming they're talking about the war in the Ukraine. If that
I assume the same.
So the thing is there may be some companies that might perform better, but I would recommend forget that. Why? Because why do we need to invest for a war in a company that might be supplying these products in America for America to give them away to a foreign country to use our weapons to fight Russians in the Ukraine when the whole market is going down because of the war? In this particular case, I don't see refuge anywhere. I don't see it. I don't think there's an island we can live on. And I totally disagree with the James Cramer saying there's always a bull market somewhere. Well, fine, but when people get afraid, they sell everything. They sell their Bitcoin, they sell their stocks, they sell their defensive stocks, their Apple stocks, the things that they thought they would never sell, they will sell if they feel that they could lose it all. And we are in a situation where we haven't got there yet. And another thing is that in this particular case, it's not a war that really makes a difference in America. It's a war where our country is giving these products to another country. There's really no huge advantage for Raytheon or United Technologies to build that added missile that will be paid for our government, that ultimately we pay for in our taxes to give to the Ukraine. Ultimately, this doesn't really is going to affect the earnings of these companies. It'll keep them very stable, maybe, but it won't matter. When prices are going down and the fear gets enough, they will sell that stock along with everything else. The goods will go out with the bads. So, no, don't look for that this time, folks.
Got it. Thanks. Kelly, I want to jump in with a question here of my own, just to clarify a couple of things we talked about before. You mentioned if you get fearful enough, you'll sell everything. Bitcoin, stocks, the kitchen sink, everything. Now, how do you reconcile that with the conversation we just had about how, well, I'm afraid, so I want to not sell, I want to stay in? How does one relate to the other? And what comes first, and how do you reconcile the two?
The hardest thing in the world, I think, for people that are controlling their own portfolios, and I know many of them, is to sell something that they have a loss in. Because they don't, the general mentality of people is they don't want to lose. They're willing to break even, but they don't want to lose.
Mm-hmm.
But when they lose enough, they give up.
Mm-hmm.
So the way I would reconcile that is that we're down right now about 22% of the S&P. If you feel that's all the market is going to go down, then I wouldn't sell. But I started this conversation with the opinion, my opinion, for whatever it's worth, is that the market has much lower to go. So say you own a stock and you've lost some money in it, but you're still breaking even, maybe you have a small profit, but you gave up a lot of profit. And it's something you were very comfortable with, like Apple.
Okay.
If you knew that Apple was going to 100, you would obviously sell that right now because it's at 147. But you don't believe that. You don't believe me. You don't believe the AI. You believe Apple's been a great stock my whole life. And for many people, it has been, including me, by the way. But I sold mine. I didn't sell it at the highs. I could tell you that, everybody. I sold a holding that I love. Not because of the company, but because it's been good to me. But right now, if I believe it's going to 100, and I strongly believe that, I can't own it at 147. It's really difficult to get rid of things that have been good to you and admit in thinking that, oh my gosh, if I sell it now and it goes up, I'm going to really regret it. And I can't be sure that it's going to go down. So that means that people are still married to their stocks. And folks, something I've said before, we do not marry stocks, we date them. Mm-hmm. We might have a long-term relationship with them, but it's still a date. And if I need to move out, I'm moving out. And that's the way I feel about the market right now. I have the strong opinion. I personally would sell today's rally. I didn't because I was busy all day. But these are things, today's rally is not the start of any bull market. It was just a response to the foreign exchange markets and the interest rates markets because they're oversold. That's the only reason the stock market bounced, the only simple reason. And that's not enough for me to buy a stock market. I remember one last, before I get to a question, I remember someone saying today, look at Boeing go today. Look at Boeing go, up 5%. It was up 5%. It's up 4%, up 593. Look at what that did. Look at that little, see that little green dot, everybody? That was what they got to talk about today. So to me, this is laughable. Like, here's the diamond in the rough. Sell it.
Yeah.
What an opportunity. Went up $6, sell it. So I remember after COVID, this stock was all the way down here. This is no rally, folks. It got all the way back up to 280. Look where it is now. It lost more than 50%. And they're going to talk about a 5% rally that it makes no dent in a chart. It's laughable. So my opinions today are extremely strong. Please recognize that. I do. I recognize my opinions are strong because I've got conviction that the market has lower to go. And it's not scary when I hold almost no stocks. So as long as you're mostly in cash, you can hold what you got if you want, because you got a lot of cash to buy something that's going to be a bargain later. And that's where we really make the money. The main thing I'll remind everybody of, the way it was taught to me, was you stay out of the bad markets so you have money to invest in them when they're much lower. And this is what Warren Buffett did. This is what good hedge fund managers do. The only difference of a hedge fund manager is he's able to short it. But if we just step aside as regular investors, we're behaving like a hedge fund, only that we're not profiting on the way down. We're taking minor losses, where the main part of America and the world, frankly, is getting their lunch handed to them. And it is only begun.
Yeah. And by the way, if you didn't already recognize what Kelly said there were some golden nuggets. If you are a trader or an aspiring trader where you want to get good at the art of buying low and selling high yourself, that is, I'm going to have to cut this video and replay that clip and send it out to everybody, because that was just golden trading psychology, like 101, golden nugget. If you want to actually execute buy low and sell high, but you haven't been able to, what Kelly just said is more than likely the majority of the reason why. And so let's we'll have more of this conversation in Dallas. So please, again, this is why I feel like it's such a great time for us to be hosting this event. We didn't mean for this to happen, but the market has been giving us all these crazy, unprecedented moves and dislocations and all this crazy stuff happening, where it's not enough. If you really want to get your handle on your finances and really understand the financial markets, it's not enough to just have iFlip and coast and be like, it's good, we'll protect your money, we'll protect your investments, but there's a lot more stuff going on that is beyond the scope of just the stock market. And that conversation is more relevant now than ever. So I really feel, once again, I extend the invitation to all of you, come hang out with us in Dallas, and let's learn together. Okay, I'm going to be learning a ton. I know that. I'm super excited. Okay, yeah. All right, let's move on to we got like 2 more questions, Kelly, and then we'll wrap. Let's see. I lost my place. Okay. Any currencies worth buying through Q1 2023? The real, I don't know what currency that is. The euro, the real. Oh, sorry, I can't read. What about taking advantage of the strong dollar to invest in real estate in other countries? Very interesting question.
Well, first of all, actually, that last thing you said is probably a really good move, right? So if you have some place in Ibiza or in some place in Italy, folks, that you've been eyeing, your currency is so strong right now that is actually, I think, actually a very good idea. I think, especially if you would want to live there too, because here is a time that I think real estate is a longer term investment generally, unless you're a hard money lender. So It's actually something I looked at, and maybe in the south of Spain. Not Ibiza, I'm too old for that. But I think that's actually a good thought. If anybody is eyeing real estate over in offshore, yes, it is definitely probably a good time. Prices are coming down in their own currencies, and the value of our currency is become extremely good. So this is the first time, maybe historically, where an American can have a really good shot, for example, of buying a flat in London. London is some of the most expensive real estate in the world. And guess what? You're getting it at right now $1.08. I suspect you can get it even cheaper. And those are things that I think over time will definitely maintain their value. But there's one issue that, remember, I mentioned, everybody, that we have to be cogent of, and that's the fact that these currencies could devalue. Because that's the really only answer, I feel, to the issues that they're facing in some of these European countries, at least, that they have so much debt, much more debt than we do. We are about 1.3 to 1 on GDP. So we have, if GDP is 22 or 25 trillion a year, we're approximately, that means we have debt of about 33 trillion, about 1.3 to 1. Other countries, note, are as much as 2.5, like Italy is 2.5 to 1. They have GDP maybe around number area of 6 trillion US in US dollars, but they have debt of 18 trillion. So the reason they have that much debt, pardon me, everybody, the reason they have so much debt is because so many social programs exist over there that they had to borrow to effect their social programs. So that's the reason the real estate thing may not work, but it doesn't matter, because at the end of the day, if it's in your owning currency or real estate in their terms, it doesn't matter if it devalues. It does if you ever try to get your money out, because you got to sell it for, say, lira, if you buy in Italy, and your lira will not translate to the same dollar amount if they devalue it after you bought it. But I do commend you for thinking that way, because I'm looking at it too. Was there another part to that question?
No, that was it. Well, the first part of it was any currencies worth buying through the first quarter of 2023.
Oh yeah, that's what the other one. Look, I am really focusing on the Japanese yen, really, only because they have an issue there that is different than the other issues. One of them is that they don't have the same amount of debt as other countries. But the other issue is that most of their bonds are owned by the central bank. In other words, they didn't sell them around the world like we sell our bonds, or the European community sells their bonds. They have actually, the Japanese central bank, the Bank of Japan, has bought their own country's bonds, which means they hold a high inventory of government issued bonds is owned by the Bank of Japan. That's unusual. And the real issue with that is I think that this creates a worldwide calamity at some point. This is a shoe that can break, that actually sends where even if the Japanese yen gets much stronger, it could also send their interest rates obviously much higher. And it could mean that it could decouple from the US dollar in a deeper way. And that could be problematic to the world, because remember, folks, at one time, this was the second biggest market in the world. In other words, it did the most GDP. Before the euro came out, Japan, next to the United States, were the two biggest economies in the world. And it's still a huge economy. So, and it's still bigger even than the German economy or the Italian or French economies alone. But it's not bigger than the euro, however. So I do look at the Japanese yen. I think also there's maybe a long-term prospect down the line in both the euro and the British pound as well. But I just don't know where. And I'm trying to find a way to do it so that we're just not all in. You got to have some kind of a hedge. So, but we're in brand new territory with this. when you break into new lows, folks, like we have in the euro and the Japanese yen and even the British pound, where is the top? Remember a while back, we looked at this dollar chart, we were looking over here. And then this happened. On our last AI circle, we were here. So this is something that's going on. These currencies, if we were to say this is the high in the dollar, we should probably sell the dollar. Well, I would have lost a bunch of money. Each one of these points is a figure. So it went from 106 to 112. Obviously everybody knows on a futures contract, that's $6,000 on one little contract. So it's very easy to get wiped out in these markets unless you're really well timed or you really have a lot of cash. So we want to try to find the right vehicle. But yes, there's opportunity all over the place, folks. It's just not in the stock market right now.
Right. And the last question for tonight is, what is your opinion on Ethereum?
Wow. Let's put it up.
Yep.
I mean, from a pure chart perspective, it does not look good, folks. And it's hard to be, I think there's going to be a massive opportunity in it within the next 6 months when we get to see how the stock market kind of falls out. And like I said, I suspect it lower. That's going to keep pressure on Ethereum, Bitcoin, Litecoin in the short runs. So right now, if you're owner of it, I wouldn't sell it. If you own it here, don't sell it. If I don't feel that I don't feel that a rally in the stock market is going to give it much up, but the probability of that is low. But I do feel the probability of the stock market going down is high, but I don't know if this is going to lose much. So I would be a holder of Ethereum and Bitcoin at this level for now. And that's my answer to that. If there's no other questions, I want to point one last thing out to everybody.
Go ahead.
It's the energy markets. One thing we might have noticed is the energy markets have come off their highs. This is 120 a barrel on the crude. US oil represents the price of crude oil. And it's gone all the way down to 81. It was actually in the 70s. Was up today. It's now trading aftermarket. So you would think that if the oil market came down this much, which is literally from 120 to 80, well, that's about a third in price, right? Close to a third, a little maybe greater. You would think that the stock market would have liked that as deflationary, and that means it would quell inflation. But it didn't. And the stock market went lower as well. That says something else is going on. You know what that is, everybody? It's called demand destruction. The market recognizes that if the stock market is going down, people don't feel the wealth that they felt literally 4 months ago or 3 months ago, or especially 6 months ago. And when you have this wealth effect being challenged because inflation, and then you see the culprit of inflation, which is oil, go down, you would suspect that that should be a good thing for stocks. No. What that is again, to repeat, demand destruction. They are expecting a recession, and layoffs are what come with a recession. When layoffs come, with Americans having some of their highest level of, by the way, credit card debt, that means that we are going to see problems in the real estate market, because if people don't have jobs, they can't pay mortgages. They can't pay rent. And that's really what the oil market is predicting. It's predicting recession. That, along with an inverted yield curve, a change in the secular trend of rates, the poor management of the Federal Reserve, being late to the issues that they perpetuated during COVID, along with poor management by our people in power right now, are what created the demand destruction that moved oil prices lower. Oil prices may be at a near-term low, but it has no effect on the stock market. And if anything, I kind of suspect in the coming months, as we go into the winter, there could be huge problems in Europe that will affect these prices, even if there's no demand. So the oil market is no longer our friend. I've basically moved out of my oil positions in Exxon. I remain very steadily and steadfast, however, committed to the pipelines, because the way to cure the overall problem is the pipelines over time. And this administration, of course, doesn't like them, but there will be another administration after this that will obviously rebuild the pipeline issues, both here and in Europe. So this is something to note, that oil will also represent an opportunity, but not right now. And don't look for oil prices to help the stock market, even if they go lower and have a less of an impact on inflation. It's only because the market is signaling a recession, and that recession means layoffs. When layoffs come, that changes who wants to own stocks. They're going to sell stocks to be able to try to pay their rent and their food bills. So that's where we're going, folks. That's why please stay aside. Let the calamity work itself through. And that is definitely not now. And so my opinion is to stay on the sidelines. Let's watch. Let's wait for some signal that comes from somewhere, hopefully AI. But right now, AI is firmly negative and becoming more negative, as we see, especially some of our metrics that we use to feed AI are expanding. And one of them I already mentioned, credit card debt. So
how does what you just said affect the red oil smartfolio, Kelly?
Red oil is going to be moving out of its Exxon, and it remains strong in Oxy. Why? Oxy has warrants that Warren Buffett will exercise at some point. It's done basically well. And so even though PAA and ET also in the portfolio are the pipelines, we are owning some cheap stocks that are paying 8% dividends, folks. So when you get an 8% dividend on a stock and it's only priced at $11, and the upside of that is 80% higher to 100% higher over the next 2 years, there's no algorithm, there's no AI that's going to outmanage a cheap ownership position in something that has huge upside, paying a dividend, and very little downside. So the AI has very little effect on those kind of metrics. And so when we formed Red Oil, that wasn't AI based, that was opportunistic, and the opportunity still exists. However, Exxon will be a component that will be probably removed on October 1st. And Exxon is still kind of held in there. It went from 100, basically 98, paid a lot of time at 98, and it's moved down to, where was it? It went as low as 81. Help me find it.
Go up, the red one. Yep.
It's 88 now. So, I mean, within anywhere in these area here, we're still within the cluster of the highs. By the way, in Dallas, everybody, these will be the discussions happening, and there will be trading techniques designed around these kind of things that some of the presenters, including me, will present. And it will not have, I'll talk a little bit about AI there, but I will also reach out and talk directly about the trading signals that you would use to manage positions in these kind of markets, especially if you had options accounts and or futures accounts. So another reason to attend the Dallas event if you can.
We have so many cool new things. Our latest addition to the lineup, since we're on that topic, is a day trader who has won over 30 international trading competitions. Did you guys even know that they had trading competitions where you sit there day trading and whoever does the best, right? They stay, and it's an elimination game. I didn't know that stuff existed. I think that's fascinating. We have somebody who's won over 30 of them. championships on 30 of them. So you want to learn to trade. I mean, there's really no better place to learn from that kind of stuff. Obviously, with AI and iFlip, we're not a day trading platform. We're not playing that game. But for those of you who do want to play that game, there's really no better person to learn from than our speaker. Couple of housekeeping questions, housekeeping items before we wrap here. Our AI Circle is on the fourth Wednesday of every month. In 2 weeks, that's the second Wednesday of October. That is the mailbag episode where you get to send in even more questions. On mailbag episodes, rather than Kelly, we have our director of sales and iFlip, Lee Gearhart, who co-hosts with me, will address a lot of your questions. If you want to ask me futures questions, Forex questions, options questions, I'm not as capable of answering. But those types of questions are a great time to submit for the episode coming up in 2 weeks. If you have questions like that, or if you want more information, send an email over to mailbag@iflipinvest.com. I don't have a slide for it, but it's easy to spell, mailbag@iflipinvest.com. And then I think I mentioned before that we wanted to have our AI Circle in Dallas, but I think I had a little bit of a brain fart, and I didn't realize that it doesn't quite fit with our second Wednesday of the month, fourth Wednesday of the month. So that is now a pending item. We might not have it. We don't know what the schedule exactly is going to look like. It might not be. We might not be able to technically, feasibly, actually, physically do the AI Circle there. So we might just do it the normal way on October, the fourth Wednesday of the month in October, which is October 26th. Okay, that's our regularly scheduled programming. So we might just do it then. And that announcement is soon to come, but I just got a million things to sort out before I finalize that decision. So please bear with us on that. Okay. And I think that about wraps it. We went a little bit over today. Thank you, Kelly. Your voice stamina held up this time. Thankfully, glad that you're feeling a lot better.
Thank you.
Yes, absolutely. And we need you healthy for Dallas, man. You know.
I'm looking forward to Dallas. And by the way, everybody, if you're still out there, this is one of those times where it's so easy to speak to the markets, because generally I know where most portfolios are and that we're in a position of strength right now. And I'm particularly in a position of conviction, at least on my opining. And this is one time where AI and I are completely congruent. At every level. So hopefully you didn't I wasn't overwhelming to everybody on my conviction in being such a bear, because I am not. It's just right now, I just feel such a sense of obviousness that I really would want to hopefully steer someone away from saying, oh, maybe I should even nibble. There's no cracker out there right now that tastes good. So we got to wait for some cheese to put on it. Now, on that note, folks, my final metaphor of the day, all the very best. See you next time, everybody.
Okay. See you on the mailbag episode in 2 weeks, everybody. Good night. See you in